Ever wondered why people make such a big fuss about credit scores? Well, let's dive into that today. Imagine you're in a world where you're constantly being assessed, rated, and scored. Sounds daunting, right? In reality, we live in that world. In the realm of finance, your actions, decisions, and habits are constantly being watched and measured in the form of a credit score. A credit score is like a financial report card. It's a 3-digit number that lenders use to evaluate your creditworthiness. This score is a key determinant of whether you get that dream house, that shiny new car, or even that business loan to kickstart your entrepreneurial journey. You see, lenders want to know how risky it is to lend you money. Will you pay them back on time, or will you default? Your credit score, based on your past behavior, helps them make that decision. A high score tells lenders you're a safe bet, leading to loan approvals with better terms and lower interest rates. But the impact of your credit score doesn't stop with lenders. Landlords may check your score to decide if you're a reliable tenant. Some employers might even peek at your credit history during the hiring process, especially for positions that involve financial responsibility. You might be thinking, well, I don't plan on getting a loan anytime soon, so why should I care? Here's the thing. Your credit score isn't just about borrowing money. It's a reflection of your financial health and responsibility. It can impact your ability to sign a lease, get a cell phone plan, or even secure certain jobs. It's like a passport to financial opportunities. A good credit score unlocks doors to better deals and benefits, while a poor score could limit your options. So it's not just about making big purchases or taking out loans. It's about your overall financial well-being. A strong credit score makes life easier, providing greater financial flexibility and security. So it's clear that your credit score holds a lot of power over your financial opportunities. Before diving into how to build credit, it's crucial to understand what it actually is. When we talk about credit, we're referring to the trust that lenders, like banks and credit card companies, have in you to repay borrowed money. This trust is often measured in the form of a credit score. It's like your financial report card that lenders check before deciding whether or not to lend you money. Now you might ask, what's a credit score? Well, it's a 3-digit number that typically ranges from 300 to 850. The higher the score, the more trustworthy you appear in the eyes of lenders. So, how is this credit score calculated? Great question. There are several factors that influence your credit score. First up is your payment history, which makes up about 35% of your score. This includes whether or not you've paid your bills on time. Late or missed payments can negatively impact your score. Next is your credit utilization, which accounts for nearly 30% of your score. This refers to how much of your available credit you're using. Generally, it's best to keep your utilization below 30%. The length of your credit history makes up about 15% of your score. This includes the age of your oldest credit account, the age of your newest one, and an average of all your accounts. New credit, which is the number of recently opened credit accounts, makes up roughly 10% of your score. Opening too many new accounts in a short time can lower your score. Lastly, your credit mix, or the different types of credit you have like credit cards, mortgages, or auto loans, makes up the final 10%. Remember, your credit score isn't just about getting loans or credit cards. It can also affect your ability to rent an apartment, get a job, or even your insurance premiums. Now that you understand what credit is and how it's calculated, it's time to learn how to build it. The first step to building credit is actually establishing it. Now, this might seem like a catch-22. How can you build credit if you don't have any to begin with? Don't worry. There are several ways to get your foot in the door of the credit world, and we're going to explore a few of them now. One of the most accessible ways to establish credit for the first time is through a secured credit card. Unlike regular credit cards, secured cards require a cash deposit that serves as your credit limit. This reduces risk for the card issuer, making it easier for those with no credit history to get approved. It's like training wheels for credit. You make purchases, pay off your balance, and over time, demonstrate that you can handle credit responsibly. Another option is a credit builder loan. These are small loans offered by some credit unions and banks, designed specifically to help individuals build credit. The money you borrow is held in an account while you make payments. The lender reports your payments to the credit bureaus, helping you establish a credit history. So, in essence, you're borrowing from yourself to prove to lenders that you can be trusted to pay back money in the future. Lastly, becoming an authorized user on someone else's credit card can also help you establish credit. This means you can benefit from their good credit habits, but be aware, their bad habits can negatively impact you too. It's essential to have a candid conversation about financial expectations and responsibilities before going down this route. Remember, these are just stepping stones. The goal isn't to rely on secured cards or credit builder loans forever. They're tools to help you get started. Once you've established your credit, you can apply for regular credit cards, auto loans, or even a mortgage, and enjoy the benefits that come with good credit. So, there you have it, folks. Establishing credit isn't as daunting as it may seem, whether it's through a secured credit card, a credit builder loan, or becoming an authorized user. There are options available to you. Once you've established some form of credit, it's time to move on to the next step. Establishing credit is just the first step. Maintaining good credit habits is where the real work begins. Now that we've covered the basics of credit and how to establish it, let's dive into the key habits that help maintain a healthy credit score. Remember, it's not just about getting credit, it's about managing it responsibly over time. First up is the golden rule of credit management. Always pay your bills on time. This can't be stressed enough. Late or missed payments can have a significant negative impact on your credit score. So, set reminders, use automatic payments, do whatever it takes to ensure your payments are never late. Next, let's talk about credit utilization. This is the ratio of your credit card balance to your credit limit. It's recommended to keep this ratio as low as possible, ideally below 30%. High credit utilization can signal to lenders that you're relying too heavily on credit, which can negatively affect your credit score. Another crucial habit is to avoid unnecessary debt. This might seem like a no-brainer, but it's easier said than done. It's tempting to use credit to fund a lifestyle beyond your means, but remember, every dollar you borrow is a dollar you'll have to pay back, often with interest. So live within your means and borrow only when necessary. Regularly checking your credit report is also a good habit. It allows you to spot any errors or fraudulent activity that could harm your credit score. Most credit bureaus offer one free report per year, so take advantage of this. Lastly, don't forget to diversify your credit mix. Having a variety of credit types, like credit cards, student loans, or a mortgage, can actually boost your credit score, as it shows lenders you're capable of managing different types of credit. In conclusion, maintaining good credit habits involves more than just paying bills on time. It requires discipline, careful management, and a commitment to live within one's means. Remember, it's a marathon, not a sprint. Good credit habits are the backbone of a strong credit score. Building and maintaining a good credit score might seem daunting, but it's easier than you think. It's about understanding the game and playing it well. We've talked about the importance of a credit score, how it's not just a number but a reflection of your financial health. It's a measure that potential lenders use to determine your credit worthiness. It's that little secret password that can open doors to opportunities like owning a home, starting a business, even landing a job. We've also discussed the nuts and bolts of credit. Understanding what it is, how it works, and what factors contribute to your score. It's like a puzzle. Every piece, from your payment history, amounts owed, length of credit history, to new credit and types of credit used, fits together to create the bigger picture of your financial profile. The first step in this journey is to establish your credit. Like planting a seed and nurturing it, you start small. You could open a secured credit card or become an authorized user on someone else's card. Paying utility bills or rent can also help establish credit. But remember, it's not about having credit, it's about how you manage it. Which brings us to maintaining good credit habits. It's the day-to-day actions that count. Paying your bills on time, keeping your credit utilization low, not applying for new credit too frequently, and keeping old credit lines open. These habits are like watering and tending to your plant, ensuring it grows healthy and strong. In the end, building and maintaining a good credit score is an ongoing process. It's a journey, not a destination. It's about making smart, informed decisions and being consistent. Because at the end of the day, your credit score is more than just a number. It's a testament to your financial responsibility. Remember, the journey to a great credit score starts with understanding its importance and taking small, consistent steps to build and maintain it.